Hi, this is Yanni from Stocks University. In this video, we'll cover the basics of technical analysis. Technical analysis is the methodology of forecasting future price movements based on the study of past price movements and market data, such as price and volume. Note that technical analysis does not pretend to be 100% accurate. However, it can help investors and traders evaluate with greater probability the direction of the price over time. Fundamental analysts examine company data such as earnings, dividends, assets, and various ratios. Technical analysts, on the other hand, employ other methods and tools. The main tool used by technicians, as technical analysts are called, is charts. Using charts, technicians try to identify price patterns and market trends in the financial markets. From these patterns and trends, they try to foresee future price movements. Technical analysis is basically applicable to any financial instrument, including stocks, indices, currencies, commodities, and financial futures. All these financial instruments have one thing in common. Their price is influenced by supply and demand. The levels of supply and demand vary from one time period or time frame to another. It is therefore up to the technical analyst to decide which time periods or time frames to use when analyzing the chart. As mentioned in a video about time periods and time frames, the technical analyst can set the chart to show time periods that last hours, weeks, or even years. Time frames are usually set to 1 to 30 minutes, hourly, daily, weekly, or monthly. Short-term traders generally use intraday charts ranging from 1 minute to hourly or 4-hour time frames. Investors and traders, however, may use daily, weekly, or monthly charts for the analysis of longer-term price movements. There are several principles at the base of technical analysis, of which 3 are the most fundamental. 1. Price discounts everything. Technical analysts believe that the current price fully reflects all the relevant information, and therefore the chart represents the fair value. Technicians utilize the market's knowledge reflected in the chart with the purpose of interpreting it and forecasting future prices. 2. Prices move in trends. Technical analysts believe that prices move in trends, up, down, or sideways. Once the trend is identified, the technician can trade or invest based on that trend with higher probability of success. Stock investors mostly look for stocks with strong uptrends. An uptrend begins when a higher high is formed. The uptrend can be interspersed with trading ranges. Once the price breaks above a trading range, the uptrend is renewed. A downtrend begins when a lower low is formed. 3. History tends to repeat itself. Technical analysts believe that traders and investors as a collective repeat the behavior of the ones that preceded them. Because this behavior repeats itself so often, technicians believe that such predictable price patterns will develop on the chart. Recognition of these patterns can help the technician select trades that have a higher probability of success. Technical analysis has several strengths and advantages. 1. It's fast and simple. Chart analysis can be kept quite simple with the usage of basic indicators or identification of interest zones. In such cases, the technical analysis does not consume a lot of time. When analyzing multiple stocks, this is an important advantage. 2. All the data at a glance. As mentioned earlier, the price discounts everything, so the technician doesn't have to look further than what the chart has to tell. 3. Timing entries and exits. It is much easier to time entries and exits according to historical prices and indicative patterns on the chart. And 4. The trend is your friend. Trading with the market's trend is safer and increases your chances to be profitable in the long run. However, technical analysis also has some weaknesses and disadvantages. First, it is less useful for unexplored territories. This means it is harder for a technical analyst to analyze new stocks and stocks that reach unprecedented prices, all-time highs or lows. And second, it is prone to noises. Usually on lower time frames, many signals to enter or exit soon turn out to be false signals. Remember that every trend is also comprised of counter trends, corrective moves, or sideways movements. To summarize, technical analysis is a very popular and common method for analyzing and forecasting price movements. It is applicable for virtually every financial instrument. Charts are the main tool technical analysts use. Although technical analysis is not 100% accurate, it has many advantages. Thank you for watching this video. I hope to see you on the next one.